Back in 2014, I was told by a director of a Swiss refinery, his refinery was taking in gold from the Middle East in LBMA bars, 400-ounce bars, re-refining that into the new Chinese 4/9s 1 kilo standard, and then shipping it back into the Middle East. In other words, even that long ago, 2014, the people who really knew what was going on, who had the vision, if you like, for the region, the future of the region, could see that their future was going to be in Asia, not with America and not with Europe.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for August 14th through August 21st, 2023, while supplies last. This week we feature Silver Buffalo Rounds from Bulmint in Bulgaria at just $2.50 over spot. The Bulmint Buffalo is a new take on the Silver Buffalo, with unmatched 4/9s fine purity. Bulmint pride themselves on artistry and design, and produce a fine silver round with dueling buffalo on one side and a portrait of a Native American chief on the other. These 4/9s fine rounds come 20 to a tube and 400 to a Bulmint exclusive master box. They are available at just $2.50 over spot and are IRA eligible. If you'd like to learn more about a precious metals IRA, call us, and we'll be happy to help you in that process. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Welcome back to Liberty and Finance. We're always privileged to have this distinguished returning guest. Alasdair Macleod, a former bank director, joins us from the UK this Monday, August 14th, 2023. Alasdair, thanks for coming back on Liberty and Finance.
That's my pleasure, DK.
You've been with us many times in the past, and most recently cautioning everyone about the fragility in the banking system. You've in the past discussed the weakness of the European banks, but we've had a rash of American bank failures the second quarter of this year, and just a couple more in the third quarter, and wonder if we could touch base on that before we move on to talking about the upcoming BRICS summit in Johannesburg, South Africa next week. So first, could you give us your latest observations so that we can stay aware and prepared about the stability or lack thereof in the banking system?
Yes, sure. I think the big news is the reemergence of inflation in the form of, energy prices in particular. The oil price has moved up now from about $68. It's now currently $83, round about there. And other energy costs like gas and, natural gas, as it were, and gas in the American sense, petroleum and diesel, they're also rising. So that, I think, makes it very difficult for the central banks who are monitoring inflation at the consumer price level and fixing their policy on the back of that. And of course, the other thing is that, as I've been pointing out, at this stage, when banks become cautious about lending, then they create a credit squeeze. And, if you're lucky enough to get the bank to actually give you some overdraft facilities, then it's going to be at a higher interest rate. So the idea that interest rates are coming off is definitely wrong. And we have confirmation of this. If you look at any chart of a bond market, now whether it's US Treasuries, UK gilts, Japanese government bonds, or any of the Eurozone ones like German bonds and so on and so forth, the charts are actually horrific. I mean, what we've had, as it were, is a sort of consolidation, which has been from more or less the beginning of this year. And that's coming to an end. And some of these chart patterns have such momentum under them that these consolidations are actually being skewed upwards. Now, all this tells me that part and parcel of what I call the great unwind, the end of the fiat currency era, which came in 1971, is going to lead to far, far higher interest rates. And I think that's the big news. Now, as far as the banking sector is concerned, obviously, banks which have exposure to US Treasuries, as we saw with Silicon Valley Bank, are going to be in even greater trouble. And it's not just in America, this is everywhere. On top of that, higher interest rates are creating real crises in property lending markets, mortgages, commercial real estate, and so on and so forth. That is going to be a huge source of loss, and banks will be backing out from that as much as they possibly can. On top of that, when you get rising interest rates like that and rising bond yields and therefore collapsing bond yield prices, it undermines all financial asset values. So where banks have got this as collateral on their balance sheets, they're going to want to, they'll be looking at this very, very closely and at the margin, trying to force the pace to get out of this collateral, get out of the loans, which basically means liquidating collateral. And this is one of the things which, was noticed very much in the Wall Street crash between 1929 and 1932. I mean, a lot of the selling was banks basically just trying to get rid of collateral before, while it had any value. So the rising interest rates, I think, are probably the big story at the moment as far as the banks are concerned. And that's makes us wonder how on earth this is going to play out. I mean, obviously, we've got quantitative tightening. Now, that doesn't exactly help the banks because when a central bank does QT, it reduces the reserves, the commercial bank reserves on its balance sheet. Now, these commercial bank reserves are assets in their balance sheets. So, that's going to get replaced effectively with some other form of asset. Now, do they go into the market and buy government bonds in a falling market? Probably not. What they might do is they might buy short-term treasuries and that sort of thing, 3-month and 6-month paper, but they're not going to go much longer than that because of the risks of the losses on the principal. And so this, I think, is generating into a very, very uncomfortable position.
What you're describing sounds like is unfamiliar to most individuals because you've lived behind the table, so to speak, as a bank director. You've watched what banks have to do. You've been involved in what banks have to do for their own survival, for their own health of their balance sheet. Most individuals on the other side of the table just think about their personal balance of their accounts and so on as an individual. And you're talking about strains that are going to be affecting banks. Is it your view that this strain that's likely to be increasing on banks is poised to sort of be the fuel that might cause more bank failures in the second half of this year as it did in the first half?
I think almost without doubt. And there is another problem with this, and that is that, okay, we had Silicon Valley Bank. That was quite a large bank for a regional bank. But what happens when one of the big ones gets into trouble? Credit Suisse was sort of midwifed out into UBS. But, we're looking at very, very leveraged balance sheets, particularly in Europe and Japan. And only in the last 10 days or so, the yield on the 10-year JGB has shot up. It's basically got out of control from the Bank of Japan, who've been sitting on the yield, trying to keep bond prices up in essence. Anyway, that policy now seems to be failing, and we see that despite the yield increasing, we've seen the yen rate against the dollar go even higher. In other words, the yen is weakening against the dollar. And I think it's currently trading about 145, something like that. So, there are all these flows which I think just amount to something extremely worrying. And if you do get a large bank, failing or beginning to sort of look as if it's going to fail, the runs that occur through, the interbank markets, through repos, through derivatives, and all the rest of it are going to make all the other banks very, very frightened. And so I can easily see the situation where bank runs begin. And the problem, I think, with dealing with a bank run of that sort is that it's run first. recognition second as far as the authorities are concerned. I mean, the authorities think that they've actually de-risked the banking system. I mean, that's Basel III and all the rest of it. And they do these stress tests every now and then. And of course, guess what? They always come out as banks are fine. Oh, what a load of rubbish. They're not. So I just think that the bureaucracy in the regulators is just not prepared to handle the sort of crisis which could rapidly evolve. And it's really, when the crisis starts, it's noticed by other banks, and they're in survival mode when this sort of thing happens. Just get the hell out of any sort of connection, any counterparty risk with a failing bank. And if you've got other banks, and this is another thing, if you get S&P, say, or Fitch downgrading a particular banking system, I think they'd be very, very dangerous if they downgraded any individual bank in these circumstances because of the possibility of creating a run on it. But if they're going to be entirely honest about the banking system, which arguably they may not be, then they probably downgrade the whole, say, of the Eurozone banking system. Or the Japanese banking system, or the American banking system, or the UK banking system. Now, when they do that, of course, you've got the international counterparty relationships, which banks in other jurisdictions will want to unwind. So we live in a very, very fragile time as far as the banking system, the global banking system, is concerned.
Now, we haven't yet spoken about in detail the effect or potential effects of a new alliance of nations, the BRICS Plus. So if we could talk about that, because it seems to be yet another weight that would be thrown on the balance scale that would increase instability if it engenders selling off of dollars or dollar-denominated bonds that are held by foreign holders if they're basically jumping ship and joining a different team for the future. Can you talk to us about what we actually know about what's going to be happening and what we look towards as what that might imply for the banking system, for currency strength, etc.?
Yeah. I mean, the amazing thing is that the mainstream media hasn't reported on this at all. We're talking about, if you like, a BRICS Plus meeting, which is going to happen in Johannesburg on the 22nd to the 24th of this month, which is only, 2 weeks away?
1 week.
Yeah. So this is going to be a major event. The background to it, I think if you go back to after sanctions were first imposed on Russia, President Putin stood up at the St. Petersburg Economic Forum, and I think it was in June last year, and basically said that any country which holds dollars or euros must be mad because they weaponize them against you. I mean, this has obviously happened to Russia. The point was he was addressing 81 official delegations among the 14,000 attendees at that conference. 81 official delegations. So that's a very large number of countries. I mean, I think the total number of countries around the world is something like 170. So we're talking about nearly half the world in terms of governments attended that, heard this, and got the message. Since then, what's happened is that the Saudis in particular came out against the petrodollar, said, we're no longer going to take payment for oil exclusively in dollars, welcoming deals with China in yuan and all the rest of it. And once you had Saudi doing that, the whole of the rest of the Gulf Cooperation Council came out and did the same. So they're all attending this jamboree in Johannesburg. And of course, when you get big players like that coming out and saying, we're no longer allied exclusively to America, then you can see that a whole raft of other countries, virtually the whole of Latin America, has come out to say, well, we're actually interested in joining this, and we will accept payment in currencies other than dollars. You've got a certain amount of Africa And I think that among a certain amount of Africa, there are quite a few who would also join in. The problems that Africans have, of course, is that if they actually, the better example is Pakistan. It has emerged in the last few days, something which we knew actually when it happened, that the ousting of Imran Khan being replaced by the previous administration, basically of corruptible politicians, was engineered by the US government. So, that was sent a message to virtually every country. Look, if you're going to try and start running away from us and dealing with China and taking their currency, we will come for you. That was the message. And so this is a difficult one for all those involved. But interestingly, I saw that Jim Rickards, who's also been following this, I think at least as closely as I have, he came out with a tweet this morning saying that the latest news he has is that 60 countries are going to be attending. So that leaves only 21 of the 81 official delegations so far not declared. Now, as to what it is, the Russians, through their media channel, have quite clearly stated that on the agenda will be a discussion for a new trade settlement currency backed by gold. Now, nobody in the West is really prepared to accept that that is going to happen. And even the Indians, who are the eye in BRICS, some of their officials have come out and say, no, this is not going to happen. But the reality of it is, if you want to buy energy, you're going to have to pay on terms which the energy seller determines, or wheat, or whatever. So, and I think also that among the Latin American countries and in Africa and so on and so forth, there are quite a lot of nations who export commodities and so on, raw materials, foodstuffs and so on, who would actually like to be paid in something better than the dollar. So you can see that this isn't just a quite simple answer of India turning around and saying, no, we won't accept it, and sort of thinking they've got a veto on it. They haven't, because the veto actually is in the hands of the exporters. And all we know is that some time ago, Sergei Glaziev, who was very close to President Putin, was appointed to look at setting up a trade settlement currency for the Eurasian Economic Union. And that was way back in April, earlier this year, or was it last year? I lose. No, it was last year. April last year. The original brief was, quite ridiculous. It was obviously a political brief, and that is that, he was going to look at some sort of basket of the commodities of the nations involved and the commodities which, they may or may not export or import or whatever. But I mean, it was also in the same breath of saying that this has got to be available to other countries. Well, I mean, what the hell do you do if, say, another country wants to join this and you have to rebalance the whole lot? It doesn't introduce any certainty into the situation whatsoever. And the work I've done looking at the relationship between gold and commodities is quite simple. And that is, if you take a basket of commodities and try and use that as some sort of backing, you're far better just using gold, because that is the representative of all those commodities in effect. And so Glaziev also came to this conclusion when he wrote an article for a Russian Moscow business paper called Vedomosti, where he basically described why the ruble should go back onto a gold standard. He called it, the golden ruble 3. Now, so what's that got to do with the new trade currency? Well, one point about it is that that article was co-written by his number 2 on the Eurasian Economic Union Committee. So they're thinking the same way. And I personally believe, I don't have any evidence for this, but it seems a reasonable supposition that the work that Glaziev has done on a trade settlement currency will form the basis for the proposed BRICS trade settlement currency. So I think what we're looking at is, and it could happen quite quickly, we're looking at a new gold-backed currency. Now, that currency would not be priced in, sort of dollars, but backed by gold or something like that. No, it would be priced in grams of gold. And so it would be completely divorced from the currency scene, as it were, the fiat currency scene. That's really the only way this can practically work. And I would be fairly confident that that's the way the Russians are looking at it, because the Russians know what they're doing with this. I mean, they know a lot more what they're doing than I would say our monetary authorities in the West know. They are stuck on the fiat currency system. They like the flexibility of being able to expand the amount of currency in circulation to stimulate the economy, pay taxes, or pay the shortfall between revenue and taxes, expenses and taxes. All those reasons. They've got too used to it. But it's that's destroying our currencies. And I think when you have got a new trade settlement currency actually emerging in the wake of this BRICS conference, then the confidence in fiat currencies will begin to evaporate, and it could begin to evaporate quite rapidly. This brings me back to the level of yield on bonds. When you have an accelerated falling in the purchasing power of fiat currencies, then obviously the bonds are going to be unwanted. The US government has a funding problem, which they could probably resolve, but only at far higher yields. And so you can see that coming out of this is some sort of inflection point, which will be undermining the whole of the fiat currency system and the financial markets, which depend upon it. So I think this summit in Johannesburg is extremely important. You see the way gold is just in the doldrums at the moment. This to me looks like a market which nobody knows what to do. Okay, it's also holiday season and all the rest of it. But, this is sort of a holding pattern. Nobody wants really to take any positions. And of course, if the speculators are not prepared to take positions, then the bullion banks can more or less muscle the price wherever they want, on the basis that there is actually not much linkage between the paper price of gold and underlying bullion, because the bullion's sold out. I mean, it really is. It's not available. So if you haven't got any bullion available, then the paper price can do what it likes. It's completely false. So we're living in this sort of extraordinary situation, which I think could turn out to be very, very violent in financial terms.
You've talked, and it's been very helpful. I think what you just laid out. I think everyone should listen to that about 2 or 3 times to really absorb everything that you just laid out for us. One thing that we didn't address is who's got the gold. We've certainly heard, as you mentioned, the keepers of the Western fiat financial edifice basically mocking gold, calling it a barbarous relic, calling it something of the past, a pet rock, whatever. In the face of that official disdain for gold and its role in the future of the world's finances, can you talk to us about what we do know about which, first at the sovereign nation level, which nations are holding the gold, and then secondly at an individual level where we know culturally or otherwise there's significant differences in the amount of gold held by ordinary people?
I mean, I looked into this a long time ago, and I unearthed the regulations which appointed the Bank of China the monopoly in terms of acquiring and managing the state's gold and silver holdings. Now, part of this is obviously reserves. At that time, they didn't really declare any reserves, really. I think something like 300 tons was all they showed. But these regulations dated back to 1983, when the bear market in gold was more or less just starting. Because, the peak price was, I think, 1980, something like that. So it was not long after that peak. And if you look at the inward capital flows, when you had US corporates and some of the larger European corporates beginning to establish factories, capital was going in to build the factories and all the rest of it. All the foreign exchange goes through the People's Bank of China. And now, come the 1990s, you still had those capital flows coming in, but at the same time, exports were beginning to really grow. So there was a very substantial amount of foreign exchange changing hands, and all under the control of the People's Bank of China. And my assumption was that if the People's Bank of China just put aside 10% of those flows at contemporary prices, and bear in mind it went down to $250 at one stage, they would have accumulated something in the order of 20 to 25,000 tons. And I've had anecdotal evidence from people who know businessmen who have interacted with the Liberation Army, the People's Liberation Army, and so on and so forth, and they have been shown some of these reserves. It's just absolutely staggering the amount that they have actually accumulated. Obviously, when China decided that it accumulated enough gold as a state, at that stage, the People's Bank set up the Shanghai Gold Exchange and permitted ordinary people to accumulate gold. And in the early days, they even advertised on television, go and buy gold, it's good for you, or something, whatever the line was. Consequently, from what we can see, the gross acquisition measured by withdrawals from the Shanghai Gold Exchange's vaulting system currently totals around about 24,000 tons. So this is an addition to the gold which China originally accumulated. Furthermore, China invested very heavily in gold mining, and it became quite rapidly the largest gold miner in the world by tonnage. So all that is accumulated. And if you go and talk to anyone on the sort of, the refining industry and so on and so forth, and you ask them, do you see any Chinese refined bars? The answer is no. In fact, I did get someone who admitted that he saw a few, but he thought they had been illegally smuggled out of China. So, basically, gold is like a black hole. The gold has been going into China, for the last 40 years, 50 years. It's just gone out of our system. Russia came to this very, very late. And indeed, Russia was selling all its gold into London in the calendar year before sanctions. So only since then have they started to accumulate. But we're looking at reserves in that context mainly, but there are also two other funds. There's a state fund and there's a state precious metals fund, which my sources tell me probably contain a further 10,000 tons of gold. Also, I have other sources telling me that Iran has got probably in the region of 7,000 to 9,000 tons, which I can understand, but I've rather left them out of the calculations, which is interesting. There was a time when people were shipping gold into Tehran by plane. There were couriers going literally, with as much as they could carry, one after the other. And that must have been back in, I think around about 2010, 11, 12, around about then. So what you have, in effect, is you've got the big power blocks in Asia have very, very definitely accumulated gold. And we've now got Saudi Arabia joining them. There is a lot of gold, not so much in government hands, because that's not the way it works in Saudi Arabia and the crucial states, but in the hands of the royal families and the very, very wealthy businessmen in those areas. They have accumulated quite a lot of gold. Back in 2014, I was told by a director of a Swiss refinery, who's now retired, that his refinery was taking in gold from the Middle East in LBMA bars, 400-ounce bars, re-refining that into the new Chinese 4/9 1 kilo standard, and then shipping it back into the Middle East. In other words, even that long ago, 2014, the people who really knew what was going on, who had the vision, if you like, for the region, the future of the region, could see that their future was going to be in Asia, not with America and not with Europe. So this is why they were readying their they were recasting their monetary reserves into the Chinese standard. So this is a situation which we're now coming to very, very late in the game. And anyone in the West who sort of has something of an inkling of the danger presented to the fiat currency system of the Asians going on to some sort of gold standard or incorporating gold back into their monetary systems, they're coming to this very late. This has been something that has been evolving for a considerable amount of time.
Unfortunately, from my limited experience, we've got a fraction of a percent of individuals in the U.S., at least, who are even thinking about precious metals or participating in any meaningful way as part of their financial future. And I'm gravely concerned about what that means for the plight of most people in the West when this awakening happens and it spreads from east to west, and the West are the last to open their eyes and kind of wake up from this, I don't know what you'd call it, sleepwalking or something, that we've been under, this hypnosis of thinking that we can just follow Keynesian fiat dreams wherever they take us, and it's not going to be someplace of self-destruction. How does this play out for an ordinary individual who holds gold in the East when the new regime is established and we see, now there's a new trade settlement currency. People have talked about the formation potentially of a new bond market that's necessary to really take steps towards a world reserve currency, et cetera, or a plurality of reserve currencies, et cetera. Can you talk about how that will affect countries who are participating, who have aligned themselves with that? Not only countries, but individuals in those countries who are also holders of physical assets like gold.
Yeah. That is an interesting question, because if we're talking about the sort of earthquake, if you like, that is likely to undermine fiat currencies, that doesn't stop at the dollar, the euro, the yuan. Sorry, not the yuan, the yen and sterling. It obviously affects all the other currencies around the world. So they have to get into a plan B to somehow protect themselves from a collapse of the dollar, which I think is going to be at the center of this. And there are basically two ways they can do this. If they've got enough gold reserves, they can probably set up their own gold exchange standard. But I'm not sure that would have huge credibility, because really the point about gold is it gives credibility to your credit. This is really what you've got to try and achieve. So I think it's more likely that they'll probably run some sort of currency board system. They could run a currency board system against the new trade settlement currency if, as I suspect it will be, that is based on gold grams. So that would be one way in which they could do it. Or the other way they could do it is, following on from Glazier's paper, I think undoubtedly you'll find that the ruble and the Chinese yuan will adopt their own gold standards. So that would allow, say, the Kenyan shilling to tie itself to the Chinese yuan through a currency board standard. And I think one point worth mentioning in this is that these currencies, they have traditionally been regarded as rubbish, very, very weak. But essentially, it's a complete lack of confidence in the currencies. Plus, also, in some cases, complete mismanagement by the central bank. Zimbabwe is a classic example of that. But if a government in Africa is actually more focused on improving the overall economy, and that requires stabilization of the currency, they are in a position to do it, because they don't have all the welfare commitments which are undermining our currencies. In essence, they don't need to print money in order to survive. And I think the point about Chinese investment in these countries, they're improving the communications, road, rail, electricity, telephones, and so on and so forth. All that's improving hugely throughout Africa. And it just changes the whole thing. So it's, I think, a relatively simple thing for an African country to put its currency on a currency board standard, if you like, with something more stable than them. Now, whether they take a currency board standard against the new gold trade currency or against the yuan or the ruble, we will see in time. So I think there are ways in which this can work very, very well for those countries who want to protect themselves from a collapse in our fiat currency system. We just don't have the ability to do it, political ability, because we've got mandated costs. I mean, the idea of, say, President Biden turning around and saying, we've got a $1.5 trillion deficit, or it's 1.6, I think, is the latest estimate. We've got to cut that spending. We've got to take that out completely. And that means that people are going to have to go without this. We're going to have to stop the war in Ukraine. We're going to have to pull forces back. And all. I mean, this is politically inconceivable, particularly in ahead of an election year. And we've got the same problem in this country. So, and not only that, but we've got the intellectual problem that, we have got used to the idea that, free market doesn't work and you need to be able to stimulate it. You need to be able to manage it. And you need to have the flexibility on the currency side in order to do it. So you've got this intellectual problem. There's got to be a complete re-education. Now, that's not going to happen without the crisis happening first. And I've always maintained this position. Crisis first, solution second. I'm not saying that the solutions necessarily go to work, but they can't even identify what the problem is ahead of the crisis actually occurring.
Also, what we've seen over and over throughout history is usually the crisis is the solution that's presented is one that just basically doubles down, and while trying to maintain the power base of the existing state of the elite at the expense of the welfare, well-being, privacy, freedom, etc. of the people.
You're absolutely right. I mean, that's what they've been doing so far. I mean, the Lehman crisis, which I refuse to call the great financial crisis because I think there's a bigger one coming. But the Lehman crisis was a classic example of what you've just said. Right, okay, the Fed just writes an open check. Boom, how much money do you need? Survivability of the system is our priority. This is what we're appointed to do. And, that's going to happen again. Basically, a choice has to be made. And I know we've discussed this in the context of the John Law choice in the past. You either rescue the financial system and trash the currency, or you preserve the currency. And, it's a black and white choice at the end of the day. And I have absolutely no doubt that the authorities in what we call the developed world or the advanced world or whatever we think we are, they're going to try and protect the existing system, the status quo. They believe in the Greenspan put, that every time there's a sort of something that upsets the market, they wade in and make sure that that asset values are maintained. It's not going to work. This is the thing. I mean, eventually the piper has to be paid, and we're getting to that point.
Alasdair, I always wish that our conversations could go on forever, but with respect to your time, we want to let people know how they can follow your work if they want to get more Alasdair than they get from us on a once a month or so basis. How can they follow you?
Well, it's very kind of you to say so. I write an article for GoldMoney, which is published every Thursday, and I write a market report on Friday. So those two, those are the two activities which I really work on, apart from talking to lovely people like you.
So folks, if you don't want to miss a single interview with Alasdair, make sure you go to libertyandfinance.com. Sign up for our free email. It'll get one email added to your inbox every day with our latest interviews, including all of our interviews with Alasdair and any weekly specials. Alasdair, as always, on behalf of all of our viewers, thank you for joining us again on Liberty and Finance.
That's very much my pleasure, DK.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin, To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.